Got Mike Klein here. He's gonna school us a little bit on what's going on in the environment right now. We had some companies that approached us and said, "Hey, will you invest 500,000? We're looking to raise a $500,000 round into our seed stage, and we think it's a bad idea." Mike, why is it a bad idea?
Right. So when I started off in venture about 7, 8 years ago, it was pretty standard that you would raise $500,000 to $1 million, a pre-revenue or early revenue for a seed stage company, and then an A round investor would come in when you reached $1 million run rate. So if you're past 3 months, we're at a revenue that put into a yearly basis would equal $1 million, you are eligible. What we're seeing now in today's environment is seed rounds are becoming much, much larger. So seed rounds are becoming $2 million, maybe even $2.5 million, and A round investors are coming in much later. So when the companies reached $2 to $3 million run rate top line and had 20% month-over-month growth. So because of that, when a company raises capital at a seed round that's only say $500,000, $600,000, unless they can get to that $2 to $3 million run rate that A round investors are looking for, they're really going to set themselves up to be in a pickle, because either seed stage investors are going to say, well, we like what you guys are doing, but we want to invest at a valuation that you raised money at a year ago, or they're going to say, hey, your valuation is too high. Compound that with raising capital takes time, usually takes 3 to 6 months to raise a round, and it's a big distraction on the operations of the business, which can affect growth as well. So if you raise a small seed round, you're probably gonna have to raise another seed round. It's gonna take at least as much effort to do, and so it's just gonna be a big drain on the business. So it's better to raise a bigger Series seed just right off the bat.
Got it. So what's a worst case scenario look like for someone who raises 500K? Are they looking at a potential down round or just like no gain in valuation over the course of a year or two?
Yeah, so a worst case scenario is they haven't figured things out and they haven't had great growth over the past, let's say they raised capital for 6 to 12 months. They haven't had great growth or traction over that time period. They're either gonna have to raise capital at the same valuation or possibly even a lower valuation if they've had some hiccups. So as we know, building a company is hard. There's gonna be a lot of pivots and a lot of learnings along the way, and that can cause revenue to bounce around a little bit. And so if you have a very short runway to figure things out, weird numbers can sort of emerge that maybe if you had 2-3 years runway, you would have time to smooth that out and show a nice upward curve.
Yeah, because sales could be lumpy or something. So what's an expected rate of sales growth that you would want to see from a Series seed business?
So, it used to not be as big a focus. I mean, obviously, if you could hit 20% month-over-month growth, that was awesome. But I don't remember it historically being such a focus. So because A-round investors have pulled back, they're able to cherry pick from companies that have performed better and better. They're paying a premium for that, right? Because they're raising much bigger A rounds at higher valuations, but they're willing to pay that premium. So 20% month-over-month growth is now sort of the rule, where before, I think it was a 10% month-over-month growth would be fine.